Hey everyone, and welcome to This Explainer. Today we're unpacking a massive paradox, one that's quietly, and honestly, understandably, driving everyone completely insane. We're going to look at why the stock market just keeps throwing this massive, never-ending celebration, while everyday life feels like it is getting so much harder to afford.
Okay, let's dive right into this by picturing two people living in the exact same apartment building, experiencing two completely different economic planets on the exact same morning. First, we have Barron. He wakes up, sees a news headline that the S&P 500 closed at a record high, and literally seconds later gets a text from his landlord saying rent is going up again. He understandably sighs and flips his phone face down. Now, 3 floors up, we have Nikki. She sees that exact same headline, watches a number in her brokerage app tick up by more than Barron makes in a whole year, takes a sip of her coffee, and breezily goes about her day. Same building, same headline, two entirely different realities. And that brings us to the exact question you've probably caught yourself screaming at your TV. If the world is so obviously on fire, if everything costs way more, and nobody can afford to buy a house, how on earth can the market keep hitting record highs like nothing is wrong? Well, to figure this out, we really have to look at what the stock market is actually measuring. First things first, we gotta dismantle this huge myth that the stock market is the economy. It's not. Think of the stock market like a giant scoreboard hanging over a massive stadium. Your completely natural human instinct is to assume that scoreboard is measuring how the whole crowd is doing. But it isn't. It is measuring how a very small number of players down on the field are doing. Most of us, we're up in the stands. That scoreboard lighting up bright green doesn't mean your seat just got more comfortable or your hot dog got any cheaper. It just means the players on the field are having a fantastic night.
And here is the second layer to this whole thing. The stock market honestly doesn't care about right now. Jobs, wages, the price of eggs, that is a measure of today. The stock market isn't a thermometer reading the current room temperature. It's a fortune teller. It is a massive bet on what a handful of enormous companies will earn years and years from now. So when you feel totally broke today and the market suddenly rips to a new high, you're describing your struggling Tuesday, but the market is out there pricing in the year 2030. To make things even crazier, that scoreboard isn't even measuring your local town. Roughly 28% of the revenue brought in by companies in the S&P 500 comes from overseas. For big tech companies, it's often more than half. So that board you keep anxiously checking, a huge chunk of it is literally just measuring how well iPhones are selling in Europe or how many data chips are shipping across the globe. It was never on the same map as your local grocery store. Let's take a quick look back at history because we actually have concrete proof that the market and actual human life can wander off in totally different directions. Remember early 2020? Unemployment exploded to levels we hadn't seen since the Great Depression. People were terrified. The market crashed for about a month, sure, but then it turned right around and sprinted to brand new record highs while millions of people were still out of work. Record highs and unemployment lines were literally holding hands at the exact same time.
Which brings us to what I like to call giants in a trench coat, the total illusion of diversification. Because here's what's really wild. The S&P 500 isn't actually a rising tide lifting 500 equal boats. Not even close. There's this tiny group called the Magnificent Seven: Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla. Just those 7 names alone make up around 32% of the entire index. Think about that. 7 out of 500 companies make up nearly a third of the whole thing. And if you just slightly widen that lens to the top 10 biggest companies, you're looking at over 40% of the index riding on just 10 stocks. The last time concentration was even close to this extreme was the dot-com bubble back in the year 2000, and we have now sailed well past that mark. The S&P 500 is essentially wearing a costume. It's dressed up as 500 perfectly diversified companies, but underneath the trench coat, it's really just 10 giant tech stocks holding hands. To really put this into perspective, in 2025, one single company, Nvidia, was responsible for roughly 15% of the entire index's gain. One company out of 500 drove a sixth of everybody's returns. When you buy into the index, thinking you're spreading your money nicely across 500 businesses, you are really just heavily backing a few ultra-dominant players, while the 500th company in line gets literal pennies.
So, who actually gets paid? Let's follow the money when the market peaks.
Since the board measures global giants, the absolutely crucial point here is the severe wealth gap. When a news anchor cheerfully announces a record high, it's not like free cash is just raining down on the country. It only helps you if you actually own the stocks. The wealthiest 10% of American households own somewhere around 90% of all the stock that exists. Meanwhile, the bottom half of the country, literally half of all the people, owns roughly 1% of the stock market combined. The party is happening inside a house most people were never given the keys to.
Now, sure, a lot of people do have a 401k, but look at the math here. The median American retirement account has about $44,000 in it. If the market has a monster year and jumps 20%, that person gains $8,000 on paper. It's nice, for sure, but it doesn't buy a house. Meanwhile, a wealthy household sitting on $2 million gains $400,000 on that exact same 20% move. Same market, same day, same percentage. One person got a slightly nicer number on a screen, the other out-earned a full decade of the first person's salary without lifting a single finger. That's the Nicky and Barron divide right there.
We really need to talk about the hidden market engines, these completely blind forces that are pushing stocks up no matter what.
Why does the market keep going up when the world feels so heavy? Well, it's because the market has a couple of automated engines bolted right onto it. Engine 1 is the 401k autopilot. Every 2 weeks, tens of millions of paychecks automatically dump money into index funds. It's a massive, relentless buyer that never checks the news, and it doesn't care if the market is expensive. It's kind of like a robotic Roomba that only knows how to buy stocks. The building could be completely on fire, and it would just quietly bump into walls buying more shares. Then you have Engine 2, corporate buybacks. Last year alone, S&P 500 companies spent over $1 trillion buying their own shares. They're effectively voting for themselves and artificially forcing the stock price up. Okay, so that robotic buying explains the market side of things. But let's validate what you are actually feeling out in the real world. Since the start of 2020, overall prices are up roughly 25%. That inflation is cumulative, and you guys, it's permanent. The money in your pocket literally buys a quarter less than it did just a few years ago. If your paycheck only grew enough to catch up to flat, that absolutely does not feel like a booming economy. You have every right to be frustrated right now. And don't even get me started on the housing scoreboard. Back in the 1990s, a median home cost around 3 times the median household income. Today, it costs 5 times the median income. The share of buyers getting their very first home just fell to the lowest level recorded since 1981. And the typical first-time buyer is now 40 years old. Listen, if you can't afford the house your parents bought at 28, you are not bad with money. You are just staring at a totally different scoreboard than the one they talk about on TV. Now, to look at this totally impartially, we really have to weigh both the bull and the bear cases for the market right now. The bull case is that these giant tech companies aren't just empty hype. They are literally running the digital plumbing of the entire planet, and their profit margins are near the highest in recorded history. So maybe paying premium prices for them actually makes sense. But the bear case is equally real. By almost every long-term metric, including the famous CAPE ratio, stocks are at their second highest valuations in 145 years, second only to the absolute peak of the dot-com bubble. Even Warren Buffett's favorite market-to-economy indicator is sitting at an all-time high. Historically speaking, the market is incredibly expensive. So if we distill this whole paradox down into one single breath, it perfectly explains why you feel like you're taking crazy pills. The market measures the future, not your right now. It measures about 10 giant global companies, not 500. And it measures the people who own it, not the people who work for a living. Future, not now. Giants, not 500. Owners, not you. So what are we supposed to actually do with all this information? First off, record highs aren't a reason to just panic and sell everything. That is exactly how people lock in terrible losses. But you can hold 2 ideas in your head at once. You can keep calmly investing while also recognizing that a massive chunk of your money is currently riding on just a few tech giants. You literally have the power to spread things out. You can look at international stocks. You can look at bonds that actually pay real interest again, or index funds that give an equal slice to all 500 companies, rather than letting 7 giants wear a diversification costume. Ultimately, we have to realize that the stock market was never measuring your rent or your raise or your weekly grocery bill. It's a game played mostly by people who already own the field. And honestly, the moment you realize that, the frustration starts to loosen its grip. You stop waiting for a green arrow on a TV screen to rescue you. The real goal isn't timing a massive market crash. It's boringly, unglamorously buying your own way onto that field, one automatic paycheck at a time, until the scoreboard finally works for you. Which leaves us with one final, pretty big thought to chew on today. If that record high was never measuring you in the first place, what would it actually take to get you into the game it is measuring? Sit with that one for a bit. Thanks so much for joining me for this explainer, and I'll catch you guys in the next one.